Hi everybody, welcome to QuantCon. Our first speaker is going to be Yin Luo, and he is a managing director and global head of quantitative strategy at Deutsche Bank. He's been ranked number 1 in the Institutional Investors America Equity Research Survey in quantitative research for 4 years consecutively, and he's going to be speaking about systematic M&A arbitrage.
All right, I guess thank you for everybody joining us today. Before we dive in, I'd like to give you a little story. I think it's quite important to understand about quantitative finance or quantitative investing in particular. Right, so I have 2 daughters. Right, so one of them is 10-year-old, and like most other 10-year-olds, she loves math. Well, I don't know, like all the other 10-year-olds, but she loves math. So she does is participate in math Olympiad, which has sort of a monthly test. In my opinion, it was pretty hard. So she does this every month, and last night she came back home and she said, well, Daddy, we had a really tough test a couple of days ago. Everybody in my class failed except me. I thought that was quite impressive, right? So I know your math is good, but I don't know how you manage to not fail this really tough exam while everybody else did fail. Well, she said, well, remember, we were on vacation in Portugal and I didn't do the test. Right, so the point is just like in finance, luck probably overwhelms skill probably most of the time, right? So it's probably not so much about skill many of the times as we do backtesting. It's probably more about luck. And what we try to do, or what I try to do today is hopefully help you to understand how we can build strategies. So that's sort of, in a sense, I think Quantopian was a great idea. So you have a bunch of strategies together. Many of them are probably because of pure luck. But diversification is probably our biggest friend. So if you put a bunch of strategies together, as we know in machine learning, so we have a bunch of weak classifiers. Each of them probably doesn't have that much of predict power, but as long as they're uncorrelated, maybe they do give us some alpha. So the talk what I want to do today is about systematic risk arbitrage or systematic M&A, which I think is quite different from your typical factor backtesting, which probably most of the equity quant tend to do. I spoke about this strategy or something similar, what I call more around corporate events or event-related arbitrage at many conferences. And again, I just will do the same thing. So raise your hand if you have or have tested or used corporate events. Doesn't have to be M&A, but any kind of corporate events as part of your systematic strategy. Right, so we have 1 in the room, and this is very much, I think this very much represent how corporate events are being traded in the quantitative investing field. I think less than 5% of investors use any corporate events in their strategy, and the general sort of a perception is sort of a corporate events are rare events, right? Systematic M&A, risk arbitrage being one of them. How many companies are being acquired as of a given point in time? Probably not that many. And how do quants add alpha? We play mostly by breadth, right? So if you don't have that many companies involved in any corporate events, how do you actually add alpha? So that's sort of the things I want to show you today. Anyway, so a little bit of a commercial, 1 second, a shameless self-promotion. So we have been ranked number 1 in almost every single region on the sell side. So if you are working for any sort of institutional accounts, let us know, or you can probably contact the guys at Quantopian. We're happy to add you to our research distribution list. All right, so here are sort of 2 white papers behind it. The argument is about a risk arbitrage. The basic idea behind it is very simple, right? So we'll give you a sort of a stylized example or fact, right? So we call it acquire and target. Right, so this is about announced merger transactions. We're not really predicting or speculating merger transactions, which is covered in a separate research paper behind it. Right, so what we're talking about is company A currently is trading at $60 a share, and company B is saying we want to buy your shares at $105. And of course, immediately upon the news announcements, company stock probably jumped from $60 to about $100 a share. And if you don't really have any insider information, you probably can buy it around $100 a share. And if the deal closed on its original term, gradually you see the share price converge from $100 to $105. So if you buy at $100 a share, when the deal does close, you earn 5% or $5 a premium. And normally speaking, this is gradually moving towards the target. So the risk is fairly minimal. If it does close, for example, in 3 months, and this is sort of a great trade. And this is actually one of my first jobs out of grad school almost 20 years ago. So what I used to do is trading risk arbitrage. And has nothing really to do with quant. It seems to be really simple. You're just buying announced transactions. You earn almost like not quite a risk-free, but you earn a very low risk, but decent returns. It was mostly done by specialists. So by the specialist risk arbitrage hedge funds, and was mostly about you understanding the network or have a pretty unique network. Understanding the legal structure is far more important than quantitative analysis. So one of the key aspects, of course, is deal has to be approved by multiple regulators. So we would normally hire an external counsel to understand the legal terms about the deal transactions. And that's, of course, not what we're trying to do. What we're trying to do is how can we do this quantitatively? And, of course, almost every single index provider or bank will have some sort of structured products around the risk arbitrage based on very simple rules. The rules are normally saying we're going to buy every single announced deals. We're going to equally weight all the target companies. And I have to say the performance is not nearly as good as your specialist done of risk arbitrage. So what we want to do is I want to do something in the middle or try to do something maybe even better. So what we're saying is what are the really sort of 3 key factors behind a successful risk arbitrage? There are really sort of 3 things. One is what I call about the deal success probability. So whether the deal will be successful or not is very important, especially on the risk side. So if you look at this little chart at the bottom right-hand side chart, right? So the argument is so first of all, you don't really know, right? So you don't really know which deal will be successful or not until the deal either closes or a deal terminates for whatever reasons. And the deal can break down for multiple reasons. So any regulator almost in any countries these days can block a deal from going on. If this is a hostile takeover, so they become more complicated, the target company's shareholders or management may come up with a suite of different strategies to block the deal from happening. And what I'm saying about this is, of course, the reason I want to talk about this is the risk of risk arbitrage is more binary. So very different from our traditional risk models where we use common factors to analyze or predicting a volatility or risk. So if you look at this in the bottom right-hand side chart, you can see with hindsight. So if we can actually predict with 100% accuracy, the blue line is the P&L or cumulative returns. You can earn, the x-axis is days from announcement day. The y, of course, is cumulative performance. If you actually know which deal will go through, on average, the successful transactions, you sort of earn about 5% excess returns in about 60 days. So if you annualize, and then you can see it's a fairly smooth line. So if you look at the Sharpe ratio of the blue line, it's going to be more like a 2 or 3. So very attractive returns if you actually know which deal will go through. The problem, of course, is we don't, right? So if you look at the red line, those deals that did not go through for whatever reasons, it's also a pretty smooth line. The deal tend to lose money probably around 3%. Again, this is sort of averaging lots of losing deals. It is also very smooth. The Sharpe ratio is very high as well, but of course it's negative. The little problem is on average, so if you look at the upper right-hand side chart, on average only about 60% deals actually did go through eventually. In the financial crisis, that dropped to around 30 or 40%. So this is the little problem is we don't really know which one will go through, so we need a model to predict deal success probability rather than spending millions of dollars hiring external counsels. We want to see if there's any quantitative ways we can build a model predicting deal success. The second most important dimension is about, again, finance 101. So we call time value of money. Actually, most investors don't really understand this. Is given the same example what I talked about earlier, right? So 5% of premium you earn, that sort of depends on how fast the deal closes, right? So if the deal closes in 1 month, you earn 5% returns in 1 month. That's tremendous. If the deal drags on for 2 or 3 years, which is sometimes it does happen, and you earn 5% in 3 years, that's not attractive at all, right? So again, the problem is you don't really know Even for friendly transactions, so company A saying we're going to buy company B, the company mutually agree to do the transaction. They may give you a timeline to say we're expecting the deal to close in the second half of 2016. Right, so July 1st is second half, but so is December 31st. If you're analyzing your returns, that actually make a massive difference. Right, so the second dimension we need to model is we need to find a model to predict deal duration, so how long the deal is going to drag out. The third dimension is about the deal premium itself. Right, so again, it sounds simple. Right, so in this case, if the company is trading at $100 a share, but buying at $105, would not the deal premium being 5%? Actually, it's not. Right, so if you look at the upper right-hand side chart on this slide, this is a percentage of our transactions. And by the way, we're using Thomson Reuters, a deal M&A database, which covers almost all the major global M&A transactions over about 30 years. So if you look at the upper right, so only about 25-30% deals are cash-only deals, which tend to be easier to predict or calculate the deal premium. The other sort of a 50% is something we call other. Other basically means there's some sort of optionalities. Maybe some warrants, some convertibles, or some other optionalities about the deal transactions. In most cases, actually, you don't have all the details to price all these options. And I bet I will show you is you don't have to go to Dr. Derman's option pricing theory, which I assume none of us really care. For equity quants. And actually, you don't have to do option pricing. There's something much better and much easier, actually much accurate to price or trying to calculate the deal premium. So that's sort of 3 dimensions: deal probability, duration, and also the deal premium. So the first element I want to talk a little bit about is we need to have a model to predict deal success. And naturally, of course, the simplest of classification model is a logit model. We'll show you a couple of other machine learning techniques. But for today's time, we'll only show you the logit model. The prediction is actually fairly accurate. So again, I won't have time to talk about the technical details. So this is essentially a match sample, M&A sort of a deal probability prediction. Essentially, what we're trying to do is more of a dynamic prediction. This is quite important, meaning we're trying to predict the deal success not only on announcement day, once the deal break up, but also we're trying to updating our probability every day until the deal either closes or the deal breaks down. If you look at the left-hand side chart, the single most important variable to predict deal success or not is something we call the month or deal age. So this is actually quite interesting, meaning how long the deal is already on the market has a very strong predict power about whether the deal will go through or not. And we color coding in red basically means the longer the deal is on the market, the less likely the deal will go through. And this is quite interesting because, again, back to my old days of trading risk arb as a specialist, we didn't know there was a theory that actually saying this, but there is a sort of a perception within the risk arb communities is well, none of us really cared about the deals on the market for 3 or 4 months. Most of us spending the time on the newly announced deals, unless there's some sort of other news announced along the way. And this sort of a 3 or 4 months seems to be such a magic number. And later I will show you actually does have sort of a statistical properties behind the 3 or 4 months. So this is actually a single variable dominating everything else. The other variables are useful in predicting deal success, including, for example, the target company's characteristics. Right? So the second variable is something we call the mergence distance to default. So this is sort of a simple model to compute the credit rating or the credit riskiness of the target company. And we call color coding in blue basically means the higher the credit rating or the higher or the better the credit risk or the lower the credit risk of the target company, the more likely the deal will go through. So this is again fairly intuitive. If you're buying a company close to bankruptcy, your shareholder may not like the transaction. There may be other sort of contingencies around the transactions. The chance of the deal breaking up tend to be much higher. The third variable is something called the price to 52-week high, and this is more like a proxy for some sort of a price momentum. And we use that as a proxy for what we call the implied deal probability. Right? So the higher the current trading price close to the offering price basically means the lower the deal premium or the deal implied premium basically means the higher the chance on average market participants think the deal will go through, which actually has a pretty decent predict power. And the first one is also quite interesting, and this is something we call abnormal trading volume. Right? So what you typically see is before a deal is announced, you kind of seeing the deal, a trading volume of the underlying volume for the target company already starting to increase. On the deal announcement day, of course, you're seeing tremendous trading volume. After the deal announcement, basically the trading volume quiets down, stays at a fairly low levels. But once in a while, this trading volume is starting to jump again. And of course, most of the time we're seeing this is more like an asymmetric information. So somebody has a better information. I'm not saying insider trading, but it could be somebody has a better analytical tools, or somebody has a better way to analyze the legal structures. They're thinking there is some sort of a risk around the transactions. And normally, when you're seeing a spike in trading volume, that seems to be associated with a sort of lower likelihood of the deal going through. The bottom right shows you sort of a coefficients, the rolling coefficients for the top 4 variables, which seems to be fairly consistent over time. So the top four variables explain probably a bulk of the model's predict power. So this sort of a first model, we're trying to predict the deal, whether the deal will go through or not. The other variables may be useful to predict deal success tend to be the deal characteristics. So for example, you see hostile takeover will have a negative coefficient, meaning hostile takeover tend to have a lower probability of going through. Stock-only deals, cash-only deals, of course, tend to be more likely to go through. So this is, again, fairly intuitive. Now we'll show you how the model has been performing, and later on we'll show you how we're going to use it. Right? So if you look at the upper right-hand side chart, this is about the model's prediction about probability. And so the model does make high conviction calls. The predicted probability can be as low as almost 0% or as high as almost 100%. It's sort of a peak around 60%, which is, again, remember, this is sort of your unconditional probability of deal success. The bottom left-hand side chart shows you the model's out-of-sample performance, where the x-axis is measuring the model's predicted probability, the y is the actual realized probability. So we bucket all the deals into sort of a 10% bucket. So each one of these little dots, for example here, representing the top 5% of the transactions where the model predict was the highest probability. And you can see the realized probability also in the same range around 90%. So the model's out-of-sample predict power seems to be fairly reasonable. And lastly, if you look at the bottom right-hand side chart, the top half of deals with above median probability, they do seem to earn higher returns than the bottom half. But we're not going to use the model as alpha tool. So we're not saying you should invest only the top half of deals and don't invest in the bottom half. We're going to show you there is a better way to use a probability model, which is more of modifying our risk prediction. So again, as I said earlier, is the risk of risk arbitrage is more like a binary, whether the deal will go through or not. That's what we're going to use the probability model. All right, so that's sort of the first part. The second part of this research is about the deal duration. So how long the deal is likely to be on the market before, again, either close successfully or terminates unsuccessfully. So from announcement day until the deal finish, either successfully or not. If you look at the upper left-hand side chart, it's actually quite interesting. This is a sort of a reiterate my point earlier. The relationship between the deal probability, which is y-axis, versus the axis about the deal age in month. Right, so you can sort of see is on announcement day, everything else being equal, once the deal is announced, the unconditional probability is around 60%. So 60% deals eventually go through before we know everything else. And initially sort of stay flat. So for the first 3 or 4 months, it didn't really make that much difference. But once about 4 months, you can see the deal probability come down. It comes down very quickly. If the deal is on the market for about 12 months or so, the chance of going through is less than 20%. So long duration deals is highly unlikely to go through, everything else being equal. And of course, you have some sort of industry sort of implications. Certain industries, such as, for example, financial services or highly concentrated industries, you may have some sort of antitrust concerns. Generally speaking, takes longer. Some other industries probably take shorter. But on average, you can see long duration deals is much less likely to go through. The bottom left-hand side chart shows you the relationship between deal age and the remaining life. Right, so what I mean at that is on announcement day, once the deal is announced, on average, it takes about 120 days to complete a transaction. So average deal takes about 3 or 4 months, maybe a little bit over 4. Initially, of course, every month goes by, it takes less of additional time to complete the transactions. And 4 months, again, seems to be more like a turning point. Right, so if you go all the way to 12 months, so once the deal is on the market for 12 months, not only the probability is below 20%, even if it does go through, it takes another 160 days to complete the transaction. Right, so this is again sort of unfavor, or sort of a saying is everything else being equal, you probably want to focus on the short duration transactions. The actual model we use to predict deal duration, of course, is a fairly simple survival model. So the same model used in the medical research. And of course, in medical research, you build a model trying to predict, for example, patient life. If a patient has certain type of cancer, everything else you're treating about the patient's own health conditions, all kind of chemical or chemotherapies, all sort of treatments. You want to see how long likely the patient is likely to survive. We kind of use the same model. And of course, the goal is sort of opposite. Right? So in medical research, you want a patient to live longer. In our transactions, we want a deal to live shorter. That's how you can capture your deal premium. You can sort of see the top variables using the survival model also seems to be fairly intuitive. So for example, the single most important variable is about whether the deal is a hostile takeover or friendly transaction. Again, hostile takeover, we color code in blue, in red, basically means they tend to take longer. So this is again fairly obvious. Hostile takeover basically means is the target company management, they don't agree or disagree with the transactions, right? So if they don't agree with the acquired company management, you're kind of seeing all sort of legal battles. And they have all sort of a defense mechanism trying to prevent the deal from happening, so that tend to drag a lot longer. You also see deal month, which is the third variable, also seems to be fairly important. Right? So this is sort of a somewhat of a nonlinear relationship, but nonetheless, you can see deal age, again, long duration deals actually takes even longer time to complete transactions. Now we're going to use a duration model, mostly modifying, where we're trying to derive an annualized alpha, but we haven't really talked about the alpha yet. Well, let's take one step back to say, well, how do we actually design our strategy? So the investment universe is we only focus on the announced M&A transactions that are still on the market, has not completed. And for this specific research, we focus on U.S. targets, meaning the target company has to be U.S. domiciled within the Russell 3000 universe. The acquirer can be anywhere in the world. The acquirer can be another U.S. company, can be a Japanese company, which is sort of irrelevant. And the reason we chose U.S. Target company, again, is in the actual white paper, we study both U.S. and non-U.S. transactions. For whatever reason, we don't really know why, but U.S. M&A transactions seems to be far more profitable than non-U.S. transactions. So this is sort of the basic design. At announcement day, the company or the target has to be in the Russell 3000 universe, so we want to include a liquid enough universe. The acquirer can be anywhere in the world, can even be a private company. If you look at the M&A universe, any given point in time, we have anywhere between 50 to about 150 companies. So the investment universe is somewhat limited, so you do have a limited breadth. This is, again, one of the common criticism about why do we need to care about corporate events. You have a fairly small coverage, and later I will show you the reasons. If you look at the bottom left-hand side chart, we show you something we call a naive M&A strategy, so the red line. And this is basically saying is if we buy every single announced deals and we kind of weighting all of them, you can see the cumulative performance is a little bit better than the long-only benchmark, but not really by all that much. So this is actually very similar to the typical passive risk arbitrage index. And again, you can see the performance is maybe a little better than your Russell 3000 universe, but not really by all that much. The excess return is actually fairly small. And this is, again, a long-only strategy. In reality, of course, not every single transaction is cash-only deals. Right? So for stock exchange, basically meaning is if the acquirer is saying, we're going to give you every single of the target company shares, we're going to give you, let's say, one of our own shares. This is something we call the share-for-share exchange. Can be a combination of share and the cash. In those cases, normally in the typical risk arb deals, you would, of course, you do a natural hedge. You will buy the target companies, at the same time you will short and acquire company stock. And here we're basically saying is doing long short, so doing this actual hedge makes very little difference. It does give you some slightly better performance, but doesn't really give you, probably doesn't really compensate for the actual optional cost involved in shorting the acquired companies. Now we're going back to probably the most important part of this exercise is about the deal premium. And in reality, if you talk to the risk arbitrage traders, actually they tend to price the risk premium in a very simple way. Right? So as I said in the early example, if the company stock is currently trading at $100 a share, if another company come back to say we're going to buy you at 105, right? So you kind of saying is the premium is 5%. So the difference between the current trading price versus offering price. In reality, of course, I said is a lot more complicated for multiple reasons. Right? So one is even for cash-only deals, the acquirer can actually either increase or lower the bid. The chance of lowering the bid is very small, but sometimes it does happen. Maybe there's another competing bidder comes in, so you can see sort of the deal premium is actually a variable. But also the reason is you could have some other form of optionalities involved in the transaction. The problem is most of the time you don't really have all the information to price all these options. And they typically have a very limited history. For example, maybe part of the option has never been traded before. You cannot even compute the volatility, how you can price the options. So that seems to be very complicated on the surface. So we actually did something quite simple, but actually was very surprising. Right? So the surprising part was, before we talk about M&A, right? So the typical way we build a multi-factor model, which is sort of the basic premise of the Quantopian platform is you build some sort of a factor models and you try to predict stock returns. And what we have done in the past 20 years is we haven't touched it, but we always have this thought was we're going to exclude the takeover target companies from our factor models. And actually, you will do a little bit more, right? So the typical way is you design a factor model, you would exclude takeover target names, you would excluding all the companies involved in certain sort of special transactions. And the argument is the takeover target companies, their price or their returns are driven by something that is entirely different from your value, momentum, earnings revision, whatever factors you come up with. So that has been sort of our hypothesis for many years, although we never really tested. So when we wrote this paper, we thought we're going to just use that as example to show your factor model doesn't work. You should look at something different. For the takeover targets, they are more deal-driven rather than driven by your common factors. So that was our hypothesis. When we test actually, we find something very surprising. If you look at the upper left-hand side chart, so this is sort of some really naive factors. Low vol is basically the volatility of every single company computed as of a given point in time. Then we associate the factors with future returns. So first of all, let me describe the factors a little bit. Then we'll describe what this chart really means. Right, so the factors are really simple. Low vol basically is just volatility of each company. Quality we proxy with return on equity. Value is your typical earnings yield. So the inverse of price to PE ratios. We have a free cash flow yield. Price momentum is 12 months minus 1 month return. We have a short interest to float. We have a growth proxy with year-over-year earnings growth. Then sentiment basically meaning 3 months earnings revisions. So are really sort of a simple factors. We doubt they have a great predictive power, but nonetheless, these are the common factors used by investors to build quantitative models. The y-axis is indicating something we call IC, or information coefficient. Right? So again, not everybody use IC, so let me just explain it a little bit. IC measures your factor performance or factor efficacy. IC is basically the correlation of your factor scores or factor loadings versus next 1 month returns. Right? So if you have a perfect model predicting stock return 100% correct, the IC should be 100%. And of course, in reality, nothing comes nearly close. So the rule of thumb is if your factor has IC around 3%, we think that's pretty decent factor for US equities. So as we all know, predicting returns, in particular for US equities, is very, very difficult. The traditional value momentum signals, they will probably have IC around 5% before 2007, and after 2007, you'd be lucky to have something around 3%. And this is sort of a simple backtesting of some really naive factors, but only within the takeover target universe. Right, so we thought it's going to be around 0, but actually they turned out to be very strong. Right, so this is actually saying is if you're buying the target companies with a lower volatility, they actually, when the deal does close, again, either successfully or break down unsuccessfully, the realized returns from your entry point to your closing time is actually very strong. That correlation is around 6%, so about 2 times or 3 times stronger than your typical factors in your non-takeover universe. Very surprising. So we know there's a low-risk anomaly, right? So buying low-risk companies, it does give you slightly higher returns, but not nearly as high as this sort of a full takeover targets. The same thing for quality, for value, for every single factor. If you do the backtesting within a non-takeover universe, the performance normally would not be nearly as strong. So very surprising. If you look at the right-hand side charts on the upper right, this is a very simple model. We call it the M&A model, so standing for M&A alpha model. So very simple, equally weighted 8-factor model, but you only use this model to predict returns of the takeover targets. And you can see the average IC is actually around almost 8%. Again, if you apply the same naive model to non-takeover universe, you'd be lucky to have IC around 3 or 4%. So the performance of the simple quant model within the takeover universe is actually 2 times or 3 times stronger than a non-takeover universe. So it's actually quite surprising, completely sort of destroyed our prior hypothesis. When we think about it, it's probably not all that surprising, right? So in the earlier model, when I showed you, for example, the deal duration models, right? You do see we use the same sort of a value momentum, well, not the same, but similar value momentum factors. They actually do predict deal duration. When I showed you about the deal success probability models, you can see many of the common factors, they actually do useful to predict deal success probability. When you put them together with some sort of a mechanism, put them together, actually make such a simple factor model has a very strong predict power about the deal premium. So very surprising. If you look at the bottom right-hand side chart, all we're seeing is if you're buying the top half of deals, with above average or above median of the MA scores, so basically meaning ranked by a very simple multi-factor model, actually deliver far superior returns than the traditional, let's say, M&A arbitrage. Actually also beat our probability model. All right. So given the time, let me jump to the last element, which is seeing is how we're going to use our probability model, right? So one deal has a probability of 95%, versus another one has 0%. Well, how are we going to use it? So we're going to use it to modify or improve our risk estimate. Right? So before I jump in, let me talk a little bit about one specific statistic we call the bias statistics. So when you use a risk model, how do you know if your risk model is accurate or not? You want to look at the model's bias statistics. What that means is the ratio of the realized risk versus model predicted risk. Right, so if your risk model is perfect, your risk model is saying your portfolio, I think your portfolio should have a risk around 5% per annum. If you actually track the realized risk in the subsequent periods, it should also be around 5%. And of course, no risk model is perfect. As we know, if you look at the blue line, is the accuracy of a risk model for a broad equity market universe. On average, it's actually pretty decent. It's around one. So basically meaning the prediction versus realized is around 1. And of course, in the financial crisis, as we're heading into a crisis, risk model underestimating risk because only using the past data. As we're heading out of a crisis, you see risk model overestimating risk. But on average, it's pretty decent. But if you apply the same risk model to the M&A universe, you see risk model consistently overestimating risk. Right? So the bias stats tend to be consistently below 1. That's how would you do this? Right? So the reason is the risk of risk arb, as I said, is binary. Most deals actually they do go through. When they do go through, the risk is actually fairly modest, much lower than your typical risk model prediction. Even when the deal does break down, it's only 1 data point. If you're calculating risk as your volatility, that 1 data point still would not make that much of a difference. So all we're seeing is we're making a very simple fix. We're saying we're only modifying the diagonal element of your covariance matrix. right? So the new vol equal to your risk model prediction, so the volatility, times this exponential function, basically meaning is if the model predicting the probability is 0%, and then we keep, so this exponential equal to 1, so we're keeping the same prediction as risk model. If your model predicting the deal probability is 100%, and this is roughly speaking is we scale down the risk estimate by about 75%. And what we find is after we're making the adjustment, the risk model become more accurate. But so what, right? So a better risk model does not guarantee a better portfolio. That's the point we want to show next is well, what's the implications of a better risk model? So here we're showing you is if we look at the risk-based allocation, again, when you do build a portfolio, you want incorporating both risk and returns. But if we want to show our risk model implications, we only, of course, show the risk model using a risk-based allocation. So risk parity is sort of a simple starting point. And you can, if you compare the red bar versus blue, you do find a better risk model will give you a better, higher Sharpe ratio, but also lower maximum drawdown. Again, everything else being equal. So a better risk model in this case, it does demonstrate will help you to build a better portfolio. All right, the last slide before I turn to Q&A. So the final M&A strategy is fairly simple, as I said, is we have a sort of 3 input elements. The portfolio is constructed as a mean variance optimization. The alpha is basically based on 2 elements. The alpha 1 is based on our multi-factor model, we call it M&A model. We scale that alpha by the deal duration to derive an annualized alpha, so make the alpha more comparable across universe. Then we have a risk model here. So the covariance matrix comes from a commercial risk model. Here we use Axioma. But we modify the diagonal elements using our deal probability, which we find, again, has a significant improvement. We're running a long-only optimization, which is, again, quite important. Long-only, no leverage. The lambda we calibrated, so the model has a realized risk or realized volatility similar to a long-only benchmark. In this case, is Russell 3000 universe. So it's very simple, is meaning long-only strategy with no leverage, but actually deliver a Sharpe ratio about 3 times higher than your typical long-only benchmark, but also manage to beat even the fully active HRFI risk arbitrage index. Again, if you don't really know, HRFI is standing for a common sort of a hedge fund index. It's sort of an average of typical, probably most of the world's largest hedge funds. Definitely beat most of the passive indices or risk arb indices to a very large extent. And more importantly, sort of achieve this with no leverage. So if you look at the realized returns, it's multiple times stronger. If you look at the maximum drawdown, it's sort of a comparable again with many of these sort of a risk arb passive indices. The reason I said this is a long-only product is quite important, meaning if you want to have a market neutral strategy, so this is not a market neutral, although it's sort of a low beta product. So the beta is below 1 because we invest in takeover target companies. They're normally speaking, they tend to have a lower beta, or beta lower than 1. So if you want to convert this into a market neutral product, you won't actually short only the market. This is quite important because it's far simpler to short the market via futures or ETF than shorting every single acquired stocks. You have to figure out the hedge ratio, which is a little bit more complicated. If you do that, a long short, so hedging the market with a point-in-time beta estimate, you can further improve your Sharpe ratio. All right, so that's sort of a quick summary. Okay, a little different from, I thought it's a little different from your typical factor models. I only have about 1 minute, so if you have any questions, I'm happy to answer your questions. Oh, okay, all right, so we have a few minutes. Questions?
These slides will be available, right?
Yeah, I know it's kind of a little bit hard. Yes, it will be available.
Statistics, how do you take into account multiple bidders, where, for example, the first bidder finally terminated his bid and another one was overlapping in the same time period, but this bid was successful? Are you going to say that there was one unsuccessful, one successful bid? Is it only one successful? How do you deal with that?
Yeah, so that's a good point. Is in our what we discussed so far is a single transaction is counted multiple times. So when we do the simulation is we're going to predict the deal probability, for example, on the day when the deal is announced, but also we're going to updating that probability every month until, again, either the deal closes or the deal breaks down. So the same transaction will be counted multiple times. So in that sense, is yes, long duration deals will be counted more heavily towards compared to the shorter duration transactions. So that's probably part of the reason. So if you look at the hit rate of the model, it's somewhat inflated if you look at the bottom left-hand side chart because the same transaction, as you said, is indeed being counted multiple times. Go ahead. So the deal breakup fee is included, but again, the database is again is not perfect. We look at there are only a few M&A databases on the market. None of them is, of course, is perfect. Breakup fee is included, but I have to say there are many missing values. Also, a little bit about the data is in the census deal, the database is mostly free from survivorship bias and the look-ahead bias, but it does have some sort of a look-ahead bias. So meaning is when a deal is announced in the middle of the transaction, if the deal terms are being revised, normally the data vendor only keeping the final deal terms. So there's a bit of a revision bias. We can clean that up with another data source. So there's another database we call a Capital IQ, a key development and future event database. In that database, it does cover every single revision in deal terms, so you can manually clean up. We did a few spot check. We find the implication seems to be fairly modest. But it's very important. So for almost all the research, again, I highly recommend another research paper we wrote probably 2 years ago. Very popular, actually, if you want to build a systematic strategy. I highly recommend is a paper called The 7 Sins of Quant Investing. In that research, we discussed about the common biases in backtesting, such as, for example, a survivorship bias. Right, so we all know survivorship bias, but we did a literature review, but we couldn't really find anything about discussing about how much difference really makes. Right, so we all know ideally we want to avoid survivorship bias, but so what? If we have some survivorship bias, does it really make any difference? Well, how much difference does it make? In that paper, we discuss is for most of your common factors. Right, so if you take about 100 common factors, about 97%, if you do the statistical backtesting, using survivorship-free database versus not a survivorship-free database, for 97% of your common factors, is statistically different. For about a third of them, the direction is completely opposite. So this is actually quite shocking. You would backtest your strategy that indicating, for example, value stock would deliver higher returns in one data set. If you're using another data set, you find exactly the opposite. So that basically saying is what can the conclusion can be exactly the opposite. Sorry.
Do you dynamically adjust your position sizing according to your updated probability? And also, do you have backtesting results compare if you just use your original probability position sizing compared to your dynamic sizing results?
Yeah. So the portfolio is rebalanced every month. So for simplicity, it's monthly rebalance. So every month we look at all the deals outstanding as of that given point in time. So every single prediction is point in time out of sample prediction. So your portfolio has to be rebalanced. So meaning you don't really just trade on the day of an announcement. Actually, the dynamic rebalance will make your backtesting a lot easier than you say, well, only make a decision on the day of announcement. So dynamic adjustment make a big difference. And this is quite important, of course. Again, we discussed in another research was saying, even for the very, let's say, we call the very slow decay signals, such as your value strategy. Most investors will say, well, if I have a value type of strategy, I probably don't need to dynamically rebalance that much because you invest in value, you hopefully will capture that value in the longer horizon. Actually, we show you it's not. Even for a slow decay strategy, dynamic rebalance will still make a big difference. Go ahead.
Another question. So for this mean variance optimization, you take monthly volatility, right?
Yeah, so the covariance metric, the sigma here is estimated by a factor model.
Okay.
So this is a commercial risk model.
Okay, but in your cash deals, your volatility after the announcement will drop to zero almost. So the fact that you have to adjust with all these complicated models probability of success isn't just because you don't have daily volatilities, and if you do the same thing with daily volatilities, it will work out.
Yeah, no, the daily volatility would be a terrible prediction of a deal risk. Right, so that's sort of a most naive way to model risk. A risk model is a lot more complicated. Risk model is even for cash-only deals, even for fairly low risk risk-up deals in cash-only transactions, the volatility you can do far better than just using the historical volatility. Sorry, I think I'm probably running out of time, but we can answer that question offline.
Is this an internal Deutsche Bank product or for clients? Or
It's all for, so we on the sales side, so everything is for client use.
the ETFs that do this, just the biggest one is 130 million, and it just tracks the S&P 500.
Yeah, that's exactly as I said. Is the passive indices? None of them does nearly remotely close to do. Right, so the passive index, as I said, is pretty much as the long-only index is not that much valuable. If you look at this stats, for example, we have a bunch of passive indices. They almost have the same sharp, same returns, actually lower returns than your long-only benchmark.
That's why they have no assets.
We're kind of showing you is the reason is because they completely ignore all the key drivers of risk arbitrage.